Welcome to episode 29 of Storm the Norm, the fortnightly podcast where we pick up norms that come in the way of businesses succeeding in a disruptive world. I am Narayan.
And I'm Anisha Motwani.
Storm the Norm is brought to you in association with Grant Thornton Bharat. On to today's episode now. Anisha, I was having a conversation at home a few days back when a family member, she's an academician who's far removed from the world of business, a professor of sociology with degrees in English literature and sociology, so as removed as you can think of. And she asked this very disarming question.
I'm intrigued to hear what googly she tossed at you.
It was a googly in the sense that it was so simple yet disarming. She said, I have no clue about these venture capital firms. What exactly do they do? And as I heard myself answering it, I realized that perhaps I had unconsciously uncovered a norm that we don't actively think about, even just as a norm.
What did you tell her? I'm curious now.
My reply was that venture capital firms basically mop up money from various sources, individuals and institutions, pension funds across the world, etc. And then they pull it up to then fund startups and new ventures. Basically, they move others' money around and make more money by doing so.
When you put it like that, it sounds so simplistic. And I'm not sure VCs would like your reductionist definition, though.
I doubt it either. But as reductionist as it might sound, I do think there's more than a kernel of truth to it. Because they're not making anything in the traditional sense of manufacturing or creating. If anything, they are manufacturers of belief, getting those with investable wealth to believe enough in ventures that don't currently exist, and then back them with that surplus money that they have.
Well, when you put it like that, describing them with that catchy phrase of manufacturers of belief, it's not very flattering to VC, is it? But I see where you're going with that.
Let me articulate the norm for today before going further. It is this. The startup economy today is only about moving money, not about value creation. And I deliberately use the word or the phrase startup economy to include multiple players in the ecosystems, not just VCs. So think about it. VCs mop up money from various sources and move it to startups. Funders move that money to various stakeholders, including a disproportionately large portion to the marketing funnel, all in the hope of building an unrealistic but attractive perception of success, leading to a successful IPO, and moving more money into the hands of just a few, the original VCs and investors, founders, and a small clutch of others. So as you can see, the focus is all in creating a multiplier effect by moving money around at speed and scale. And my question is, where is value creation for the world at large, or even progressive benefit for a large set of customers in all of this?
You are not a cynical person by nature, Narayan. But this seems like you're skeptical about the entire startup ecosystem.
That's not my intention, Anisha, but yes, I do want to interrogate this to understand it better. I mean, if this is truly a norm, don't you think it's ripe for storming?
Happily for me, I can pass the responsibility of answering that question right now to an expert in the field. Our guest expert today is very well placed to storm this norm. Bharadwaj is a general partner with A91 Ventures, an Indian investment firm that seeks to partner with founders to build enduring businesses for tomorrow's India. VT, welcome to Storm the Norm.
Thank you so much once again, VT, for joining us over here this morning. So right off the top, when we spoke about this norm with you in terms of the value creation versus merely money movement, I'd like to kick it off with that to begin with, right? So with the money movement part of it, and it feels like without taking any particular instance in mind, it feels like venture capital funds mop up money from various individual and institutional investors and funds from around the world. That money then moves to startup ecosystem. The startups then move that money to various stakeholders, spending disproportionately in building their market perception with the line of sight of an IPO in mind. And what ends up happening is value creation in terms of wealth creation for a few, but not necessarily value creation in the sense that the startup was created in the first place with disruptive progress in mind. So it just feels like it's a game of a few for a few, which primarily involves money movement more than anything else. What's your take on that?
Yeah, I do think that it would be quite disappointing if that's what it turned out to be, because and of course, look, we are coming off a cycle, a very, very, very violent cycle of both liquidity as well as capital coming into India in a very, very short span of time. But then if you really take a bit of a slightly more longer picture, and if you take, let's say, even a 5-year view or a 10-year view in terms of capital that has come into a country like India for investing in startups, young companies so they can grow, the ship has been a bit more steadier, versus what the last 12, 18 months will have you believe. India used to get maybe 7-8 billion of capital every year. That has been from 2015 to 19, and maybe even 20, and 21 was really an exception where 35 billion of capital came in. And therefore you suddenly see, a wall of money coming in, and the wall of money occupies the newsrooms, the headlines, and all our minds. And therefore you do wonder what this is all about. But it would be quite disappointing, because I think the interesting thing about venture capital is really the ability to supply capital to young companies and be very patient about it for a very long period of time. It is risk capital. So this is not debt, it is equity. So unlike a bank, we're talking about putting in money where there is a real chance that you will not realize any capital out of it, with the hope that over a 7, 8, 10-year period, you build something worthwhile. And then that company eventually goes to liquidity in the public markets or gets sold to a high quality private company, because that is the goal of the founder, and that is the goal of the investor there. So in an ideal world, the way to think about venture capital is really patient, high risk, long-term capital. And ideally with patient, high risk, long-term capital, you should be able to build. So I definitely think that and believe that the purpose of venture capital is certainly long-term value creation. And then hopefully some of these episodic blips will remain exactly that, which is episodic blips versus really changing the narrative around what the purpose of the capital is.
We hear you say this whole revolving door syndrome of money, money revolving from one to the other. If that is not true, how do you explain that 4 large IPOs, Paytm, Zomato, Policybazaar, Nykaa, they mopped up 38% of all the liquidity from the market, almost 38,000 crores, which apparently is 38%. I was reading some stats. So isn't it true that by this time, the funds and all the critical early stakeholders have actually got their returns, they've taken their risk upfront, they've got their money, and, they've actually dumped the losses onto the public market?
So, I don't want to comment on a specific IPO because, I've not been involved in any of them. But I think the smart founders and the smart companies have, look, there was an IPO boom, and an IPO boom there are absolutely going to be, sins of commission and sins of omission, be it on the companies, be it on the various stakeholders during the entire process, right? And this is not characteristic of just India or outside. Or frankly, this is not just characteristic of even one kind of a company which is going out and raising money. So during an IPO, everyone is obviously believing in the best potential at the best possible time for the for the longest. So I think it becomes very hard to separate the good IPOs from the bad till you wait for some time. It takes 5, 7, 10 years before you go out and say, there was a Page Industries that did IPO in 2007. At maybe a valuation of 600 crores, where again a bunch of investors sold and the company raised some money, and that company is worth 30,000-40,000 crores today in 15 years, right? So I think it takes time. So 6 months and 1 year is too short a time to react to saying, hey, what has happened to these companies? I think the more important thing is during the IPO, the companies, the smart companies, made sure they were well resourced. So whoever would have automatically said, hey, I need primary capital for this business, and therefore I raise capital. There may be companies which didn't need any capital. In case they said, hey, look, it's an offer for sale, and that's great, because theoretically you're saying the company doesn't need any capital, then it should really not need any capital. And then the company grows, after that over a period of time. So I do hope that out of this list of people who raised money, there are at least a few which over a 5, 7, 10 year period, really build value, because that's a time frame to judge whether finally at the end of it, of course, there may be even a few investors who sold, But the ideal case is where the investors at the end of 5 years say, shit, you know what, I wish I had waited for 5 more years. Because if you go back and look at the venture capital history, the time when a Google IPO happened, or the time when a Facebook IPO happened, and many of them were thought to be very, very aggressively priced IPOs, and therefore investors and venture capital investors at that point would have sold. But the reality is, if they had held, you know, the data would show you that they would have made even more money, much more multiple of money had they held on than what they sold at IPO. Which is why the thesis in venture capital was always that, you know, the best companies, you know, you do realize, you do want to be shareholders for the longest possible time versus, you know, a shortest possible time, and then you sell and you move on.
So you still feel that there's hope for investors in these IPOs if they
I cannot comment on an individual IPO, but I do hope it would be very tragic for the ecosystem if, you know, out of this set, you do not have at least a couple which kind of lasted and created more value over the next 5 years, you know, than what it looked like at the time of IPO.
Just a quick follow-up on the VT. I mean, I can see, and I can't find any fault with the perspective that the venture capital funds come up with. But do you think enough startup founders see this perspective as sharply as you articulated it, or are they all starry-eyed with an IPO in mind when they set up?
Yeah. So look, one of the things to remember is in the startup, we are still a very relatively immature, young ecosystem. Okay. The whole venture, private investing in India, as I keep reminding people, is less than 15, 16 years old, at best 18 years old in terms of meaningful scale and size. And the venture part of the ecosystem is barely 10, 12 years old, right? So I do think that people get starry-eyed across the board, you know, and investors, companies, you know, and other people in the stakeholders. I think the question is, when setbacks come, and as for sure they have already in some ways, and they will, do you have the ability to digest that and also see that as a part of life? Because otherwise, you know, if everything only goes up, you know, you founders and investors all think that, you know, things are going so swimmingly well, that they're both incredibly smart and that, you know, they are so good. I think it takes a bit of a few setbacks to kind of separate the grain, separate the chaff, right? And realize that, hey, look, this is going to be a rocky ride, because it is absolutely a roller coaster ride. I have never seen a startup ride which is a smooth line ever in my 15 years of investing.
So what's your approach to separating the wheat from the chaff?
I have, you know, we have at A91, and I represent A91. Here is, you know, we want to back founders who are trying to build an enduring business. And to build an enduring business, you need to have line of sight on profitability. You need to have line of sight on, you know, how much capital are you going to require to get reasonable scale and be profitable and generate cash. And it's very important that founders and investors have this lens, you know, when they think about, you know, how they are planning their growth journey. You can, of course, you know, in a fast growth, see, at some level, investors and founders you're trading capital against time. So the purpose of putting in capital is to accelerate that, right? And by definition, it could be accelerating brand building, it could be accelerating a capex, it could be accelerating the build out of a distribution. And therefore, by definition, you will incur, let's say, losses in the first few years. But you need to have line of sight on two things. You need to have line of sight on at what scale are you going to be profitable, number one. And number two, at all points of time, you need to have line of sight on your gross margins. Because if you don't have gross margins, you cannot build a business. So I think that is what we try very hard, you know, Nisha, is if you are honest about how you are managing and improving your gross margins, and if you're honest about the line of sight that you have, saying, hey, at this scale, I can be a profitable business, then I think you have a greater shot at building an enduring business and creating enduring value. Now, what will be the size of that enduring value? We don't know. And that's why the third thing I'd like to comment is, you know, India is a deceptively large and a small market.
Okay.
Right? And depending upon which product category in your building, you have to be very careful about the market size that you estimate for the category. And you have to make sure that within a reasonable share of that market, you end up with an enduring business.
So actually, I built up on my follow-up rather on this, Riti, is justifiably the points that you've just put on growth roadmaps, on profitability and scale are the primary focus as a business that's in the business of growth, if you will, right? But I go back to the foundational promise of any startup, which is positive disruption, right? And in other words, progress, if you will. But really, on an ongoing basis, even in the 5 to 7 year line of sight and horizon, would you say there is as much eye on the ball in terms of that progress with that foundational promise as in terms of any metric other than just speed and size of growth?
So I think on the disruption side, right, I'm always very careful in using the word. See, no startup can succeed if it does not have something new to offer, right? And it is not possible otherwise. So it has to be something that it has new to offer. It has to be something which makes sense for the customer. So making sense for the customer is product market fit, and new is because differentiation, right? So you need a differentiated product and you need product market fit. And after that, you need an approach or a go-to-market that also is differentiated so that you can hope to scale and get to scale. I think if you don't do these things, it will be very hard to go through the journey of scale. When you see tremendous product market, just to give you a sense, that company has scaled from 35 crores to 240 crores in 2.5 years, awesome. Making money every year.
Absolutely. Narayan, last question from you.
Maybe I'll circle back to where we started also. It comes back to, I guess there can't be a science to this, but what would be an appropriate strike rate that you think, when you go to bat for startups and you make your bets, what would be an acceptable strike rate to say, 3% of my investments will pay off, or whatever number that is, and what is it that you would change in the way somebody like you, a VC, and your investees, the dynamics between them need to change in order to make the odds more favorable for success.
So look, the odds, and India is still a relatively young market, so I will rely on international markets for what it looks like. On the venture world, which is very early stage, venture investment, which is, think of it as a first check of 3 to 5 million to behind an idea and a team. I think the number used to be 50% or 40%, 45% losses, and the remaining 55%. Kind of more than compensating for the losses and generating stellar returns, right? And imagine if those funds have to generate a 8-10 times return, how much the remaining 55 should have contributed to. In the slightly more later stage, which is where we kind of operate, 10 to 50 million, you can't have, it has to be a much more balanced approach. Your strike rate is now not in terms of losing capital. It's really in terms of saying, can you have, 20, 30, 40% of the fund performing at 7-8 times? Can you have at least maybe then you have maybe 10, 20% which underperform, in which case you maybe make a return between 1 to 2x. And then the belly of the portfolio you drive towards a 5 times return. So on an overall basis, you end up at 5 times. So the stage at which we come in, which is the 10 to 50, we can't lose money. It's really saying the underperformers are those where you're generating 1 to 2 times. And then the outperformers are those where you generate 8 to 10 times. So that's the way the portfolio changes. The key, Narayan, is that the risk, obviously, the riskiest part of the spectrum is when you underwrite a very early check, where you accept, higher level of losses. I think once you start gravitating towards the larger checks, you cannot have losses because then it's too big a hole to fill for the fund to return.
Yeah, you have your own bell curve benchmark.
Exactly.
And is there anything in the investee VC dynamic that you would change for them also to see that their chances of success increase when they do that versus how the status quo currently is?
Narayan is putting it very gently, and in crude words, I would say, are you just annadatas, or are you also, guys who are actually strategically guiding your organizations to pivot and to change course and to do something strategically different, and away from the starry-eyed dreams of the founders?
Yeah. It's a very tough question. Now that you've said it the way you've said it. See, I think the first is for founders to realize that a lot of them is in actually their hands in terms of how they define the relationship and what they get out of it. Okay. Is it like Annadatta, as Anisha said, or is it something which is a lot more proactive and is a real relationship? Is very much the founders. And I do think that at the early stages, therefore, let's say an early stage I define as a journey from, 50 crores or 0 crores of revenue to 500-600 crores of revenue in the Indian context. I do think that it is helpful to have a partner who's on the same side of the table, whose interests are aligned with you in terms of what will it take to build a large business and get to a level where you're sustainable and endurable. So I think there is value in, and if that's a relationship, and for that, what is required? For that, it is an open relationship. It's bad news first. It's a bit of a, you have to build trust and you have to share what is happening in the business so that you can get inputs, if you will, as you make your decision from a couple of people who also really care for the long-term interests of the business. And look, what is the nature of the input? The nature of the input can be tactical, it can be strategic, it can be in hiring, it can be in figuring out what they want to do. But that all depends on the questions the founder is grappling with and how open they are in sharing those questions with investors.
I think, Viti, we really got some amazing responses, and it really warmed up and went off very well. Thank you so much. It's been our pleasure to have you with us, and we hope to get you back again soon on another episode.
Thank you. Thank you, Narayan.
Thank you so much for your time. Great meeting you, Viti.
Thank you.
So, Narayan, what did you take away from everything Viti said?
Anisha, I think above everything, I liked how he was realistic. He didn't completely dismiss the norm as being untrue or impossible. He acknowledged its possibility and then went on to methodically dismantle it. I especially loved his point about the current setbacks in the funding environment and startup ecosystem in India as being not just necessary, but actually a good thing. Mm-hmm. An ecosystem that does not experience any shocks can either be too good to be true or unsustainable. Mm-hmm. And so this blip, not quite a burst bubble yet, this blip will help with course corrections, but also serve as a reminder about the amazing potential of the startup economy while tempering it with reality. What about you, Anisha? How would you storm this norm, and what hacks do you have for our audience today?
While I do have the hacks as always to share, I want to set a baseline first. And, without spending too much time, I want to emphasize that no other elements can make up for the significant shortfall in quality and its role in value creation. If you are a burger maker, make sure you get the best burgers. If you manufacture cars, you have to make sure that the quality is absolutely benchmark, and so on and so forth. Don't lose sight of the core. Having said that, let's get on to the more unique hacks for today.
I'm all yours.
The first one is, do not become a victim of a zero-sum approach.
Interesting.
No organization begins by saying that it does not want to create value. But the first gap emerges in understanding who your real stakeholders are. Is it shareholders? Is it employees? Is it business partners, vendors, customers? The underlying assumption in goal setting is that there is a fixed pie of value to be distributed amongst customers, employees, and shareholders or partners. And so the interest of all these groups must be traded off against one another.
I recognize that zero-sum approach now. And this win-lose or zero-sum thinking usually happens when leadership defines the organization's goals too narrowly. So, for example, to maximize this year's or this quarter's reported earnings. And it'll view that interest as being at odds with the interests of customers and employees.
And usually what gets traded off is, a customer at the cost of revenue. Exactly. With that kind of perspective in the short term, every rupee spent on employee training is a rupee of lost profit. Every additional rupee squeezed out of a customer, even if it comes at the cost of poor service or price gouging, improves this quarter's results. Yeah. And this trade-off between stakeholders is most visible in leadership's KRAs, where a whopping 70% or more is attributed to revenue and profits, EBITDA, and KRAs like those. And the balance is frugally distributed between the so-called softer measures like employees, customers, brand. As long as management does not change this zero-sum approach, the sustainable value will always be compromised.
This is such a fundamental truth, Anisha, and I think a vastly underestimated hack, if you ask me. I think startups need to have this framed in their offices, real or virtual, because it's so critical to them, but it's also as critical to established businesses, if you ask me. I love it. I love it. What's your second hack?
It's linked to the first one in many ways. Ascribe a tangible method to evaluate the intangible assets. Our financial accounting systems have been created for the industrial economy, but are inadequate in today's digital economy. The accounting and finance conventions are good at valuing tangible assets, but they largely ignore the value of difficult to quantify assets like employee satisfaction, learning, R&D effectiveness, customer experience, brand trust, etc. In the digital age, those intangible assets are far more important than the bricks and mortar that traditional accounting systems were designed to measure.
But many of these measures are ambiguous, and there seems to be limited understanding of these.
Indeed, Narayan. And that's what makes it so complicated. Customer value, say, for example, is a dual concept. First, in order to be successful, firms have to create a perceived value for customers. Second, customers in return give value through multiple forms of engagement like customer lifetime value in the widest sense of the organization. ESG brand matrices are some of the other complex measures, and their attribution to companies' growth and valuation is even more so difficult. The time has come to first acknowledge the value of these and find a scientific way to factor them in measuring value creation.
That's so well highlighted, Anisha. Maybe we first need to stop treating these as intangible in the first place. I mean, if your people are not tangible assets in the internet economy, I don't know what to say. So that's fantastic. What's your next hack?
I think it's important that we don't chase everything. And my third hack comes from there. You have to find your own headroom for growth. In today's times, companies instinctively unleash a flurry of new activity, often overlooking the growth opportunities that are right in front of them. In their hurry to make up for lost time and see quick results, they get easily tempted by tactical opportunities or get lured by the idea of diversification without a clear sense of where the true opportunity for growth exists. That can prove costly, perhaps with disastrous consequences, at a time when resources are scarce and getting the highest yield on these resources is becoming paramount.
So how does one avoid falling into that trap?
So it's important to play to your strengths and unlock in market potential from existing by understanding where your real headroom lies. Okay. And that's what the hack is all about. If you were to create a matrix, which is along two lines, which is value and headroom. Okay. So it would fall into 4 quadrants.
Right.
There's low value, low headroom. These people are polygamous loyals. They belong to many. On the same axis, you have high value, low headroom. These people are hardcore loyals. They belong to you. They are not going to go away anywhere. Okay. Then there is low value, high headroom. These are people who are competition loyalists. You have no right to them. Ignore them. Then there is high value, high headroom. These are split loyals and they belong to few. Okay. They never belong to anybody. So what you have to do is you have to nurture your loyalists, ignore the competition loyals, try and lure the split loyals with tangible propositions, and park the polygamous loyals in the queue for better times.
So simple. And this is such a contentious dichotomy, right, Anisha, between acquisition and value sustenance through loyalty and lifetime value of a customer. What I really like about this hack is the clarity around competition loyals and polygamous loyals. And I think that's a reality that very few acknowledge. I'm really loving your hacks today.
Thank you. So here's the fourth one. And it's becoming very prevalent today. Design thinking and a design-centric culture is becoming the new tool for humanizing and creating differentiated value. There's a shift underway in many organizations, one that puts design much closer to the center of the enterprise. But the shift isn't about aesthetics. It's about applying the principles of design to the way people think and work.
I know what you mean. Design thinking first used to make physical objects is increasingly being applied to complex intangible issues such as how a customer experiences a service.
And you see how this is again linked to the first 2 hacks that we had.
Yeah.
Design-centric culture helps you exhibit thoughtful restraint. Okay. Many products are built on emotional value proposition, are simpler than competitors' offerings. This restraint grows out of deliberate decisions about what the product should do, and just as important, what it should not do. By removing features, a company offers customers a clear, simple experience. And design-centric culture helps you do that. It, rather than chase the market with many features and incremental features and follow-on features, it's important to lead the market with the designed for customer focus, few simple features.
How can anyone argue with the criticality of this? I mean, especially in the startup economy, where one can get carried away by innovation and disruption. This is such a handy hack. So what's your last hack for today, Anisha?
This one's a little more fundamental. It's about sustainable innovation across the value chain of the organization. And in many ways, all our hacks today are intertwined with each other. Most companies end up having a very narrow definition of a company's customers, and that's the last mile consumer of your product. Organizations need to see their customers as all stakeholders right along the value chain, not just the end user, but all those that help their offerings, products get to market. Everybody in the value chain is your customer. And the best example to bring this alive is India's very own Aravind Eye Care. Launched almost 4 decades ago in the form of an 11-bed clinic in Madurai, Aravind Eye Care System today is an example and a global benchmark. And there are multiple case studies written and studied around it. It's all over the internet. But it's pertinent to bring this in context to this hack, to bring this hack alive. Like any system, healthcare is a complex interaction of parts contributing to the whole. Physicians, administrative staff, insurance companies, payers, patients, caregivers, each contributing to the adoption of new technologies. Such a complex interplay of players means an in-depth understanding of who is in your system, their role in the care pathway. And this is where the real genius of Dr. G. Venkataswamy, he's popularly known as Dr. V, comes in.
So fascinating.
And you know where it all started? One of the images that impressed Dr. V most on his visits to America was the golden arches of McDonald's. And he said, why couldn't the assembly line efficiency that made hamburgers available on the street corners of every town in the world at a price everyone could afford be harnessed to the mission of fighting blindness?
Fascinating, Nisha. And so many fantastic business insights in one place as usual from you.
Thank you, Narayan.
This is also a great place to bring in our GT Bharat experts today to provide a real world way in which the startup ecosystem can go beyond being mere money movers and create real world value for multiple stakeholders. Today we have Raja Lahiri, who is partner growth and transaction advisory, as well as working with the PE side of things. He actually actively works with PE firms, VC funds, and startups, and is in a great place to provide the insight from GT Bharat today.
So welcome, Raja. Good to have you back on this new episode and on our favorite topic, which is the whole startup ecosystem. And the question straight away to you is, 2021 was a record year for the startup ecosystem when it comes to funding. With massive liquidity, VCs, PEs, angels were all wooing entrepreneurs, and the sentiment was something like this: we'll give you more money than you need, but you better go as fast as you can. If you need more, no problem, but just get to that unicorn status faster than your nearest competitor. And in this entire rat race, this whole conversation about value, sustainable value creation, just gets compromised. I just want to hear your insights on this.
Oh, thanks, Anisha. I think very, very well articulated. You talked about value creation and that gets compromised. But let me just take a little back step and just try to create what happened last year. So first of all, what's the kind of capital that got invested? $11 billion in 2021 got invested in India. in startups. So that's the highest ever. Took India to the third startup destination in the world. By the way, 2022 also saw $4.6 billion. So the trend continues, number one. Now, question on the unicorn status. Yes, there's been 100 plus unicorns in India today. And the question is being raised in terms of how many can survive on a sustainable basis. Now, my personal view is capital is lifeline for the business. So first of all, easy money, I'm not sure always because it's a private equity money. They have other investors investing into them, which comes in. So they take bets. And clearly in a market which is disruptive and which creates an opportunity, you need capital to build businesses, to disrupt and acquire customers, number one. The number two is, you talked about the unicorn status. Now, unicorn status, I agree with you that there's been a frenzy. And fundamentally, if you look at it, I always believe the market is the king. The market is intelligent and observes and corrects things as it goes on. And we've already seen that in 2022. Valuations have come down. Capital infusion, investor sentiment is also of I would say, cautious optimism as far as India is concerned, and which is a good thing in fundamental way, because we are moving to the core of value creation, as you talked about. Now, in my view, value creation is about not just becoming a unicorn. Value creation is creating value for customers, employees, investors, and the larger society. And in that case, you talked about the rat race. In all of this, speed is all, of course, of the essence. But let's not forget the age-old norm of slow and steady wins the race, which means that on a sustainable basis, companies need to focus on the foundations, which we have talked about before, which is the principles of profitable model, high quality delivery, good cash flow management, and the highest standards of corporate governance. And fundamentally, as someone said, it's not values over valuation, but it is the values which lead to value creation and ultimately value creation.
Well said, Raja. Absolutely. And some of the points that you made about the market always being 2 steps ahead of, anybody else. We think we are smarter, but the larger market forces always have a way of showing you the mirror and correcting. So absolutely well summarized. Thank you so much for that. Really appreciate your being here.
Thank you, Manisha.
A thought-provoking norm, a seasoned expert, and some great levers to storm the norm. This is a good place to wrap up episode 29 of Storm the Norm.
As always, there are multiple places you can catch us on: Spotify, Apple Podcasts, SoundCloud, and JioSaavn by just searching for Storm the Norm, and on Saregama Caravan 2.0 devices on channel 453.
This is Narayan.
And Anisha.
Signing off for now. We'll be back with a new episode soon. Thank you and talk to you.
Thank you.